Good evening and welcome. On behalf of WWM Financial and Savvy Women Wealth Management, we want to welcome you to our WWM Continuing Education and Client Virtual Appreciation event. This time of year is always special to us at WWM Financial. We usually have a brunch and appreciate our clients, but this year it looks a little different, and we're here virtually all together, and we're so happy that you're here with us. From WWM Financial, we have several of our team members here with us today. We have Naomi Mellos, Client Service Assistant. We have Ian Navachin, one of our newest additions, Financial Planning Associate. We also have Jocelyn Magana, who's our Digital Marketing Manager.
Hello.
We have Vince Stefano, Portfolio Manager.
Hello.
Greg, and Wealth Advisor with over 25 years of experience. We have Scott McClatchy, our Certified Financial Planner Professional with over 15 years of experience.
Hey, everyone.
We have Carrie Harmon, Chief Compliance Officer and Office Manager, who's also proud to announce that she is a grandma. She has a grandbaby. Yay, everyone. Was born about 6 weeks ago. And we have, I think I mentioned Greg Carroll, Portfolio and Wealth Advisor.
Hi.
And Steve Wolff, Managing Partner and Founding Member of WWM Financial.
Hello, everybody.
And myself, Catherine Magana, Certified Financial Planner Professional and Managing Partner. So we have an exciting evening in store for you. We have a few special guests joining us tonight. We have Carolyn Grant, an Executive Director for the Museum of Making Music, who will give us a sneak peek of the museum. We have Steve Wolff, who will provide a market update, and Rachel Ivanovich, an enrolled agent, will share some tax planning strategies for 2021. Tonight's presentation should be about 40-45 minutes without questions, and we do appreciate your patience as we move between our speakers and presentations this evening. There is a question feature on your panel. So once again, if you look at your control panel, there is an area where you can ask questions. And so we ask if you do have questions along the way, we will be addressing some of these questions. And if they're specific to your unique situation, we may address those offline or separately with you. If there's some general questions, we'll be able to address the group. And we hope to have some time to go over all those questions with you. And so I'd like to now kind of talk a little bit about this evening. I mean, once again, we wanted this to be unique and fun. So we asked Carolyn Grant from the Museum of Making Music to join us for a spotlight. And she is here. She's the Executive Director with the Museum of Making Music. She has over 23 years of experience and even helped with the public opening of the museum many years ago. This is her second renovation of the museum, and we're excited to get a little sneak peek of the museum. And so I'd like to go ahead and turn it over to Carolyn, and I'll go ahead and give her control to present. So just give me one moment, please.
Hi, good evening, everyone. Can you see me? So I am standing here in one of the galleries of the Museum of Making Music, the newly renovated museum. And I would like to tell you a little bit about, I'm going to talk to you for about 4 to 5 minutes tonight and just give you just a little overview of what we've been up to. So if you're not familiar with our Museum of Making Music, we are part of a century-old global organization known as NAMM. And NAMM is a trade association that supports the manufacturers and retailers of music and sound products. Our museum reflects, therefore, and celebrates the world that this association supports. So this past year, we embarked on a complete renovation. We are now in the final stages, and we will be ready to open back up to the public sometime after April, when it is safe. So a little bit more about the museum. The museum's storylines and displays reveal the ecosystem of the music products industry. It's a unique perspective on music and one that is rarely seen by the general public. We explore the making, the selling, and the using of musical instruments and sound products. So today I'm going to show you a sample of one of our interactive touch screens to give you an idea of how we present one facet of our story and one that revolves around the selling of musical instruments. So I'm going to share my screen. So this is a reenactment, if you will, of a digital touchscreen. So imagine you're a visitor, you've just seen a display of some beautiful instruments, and now you want to dive a little deeper. So what can you do? Well, this one it's going to reflect a story between the 1960s and 1980s. The topic is bigger, faster, louder. And so here are some stories that you could explore to begin with. So one story would be, how did the Beatles' 1964 appearance on the Ed Sullivan Show completely revolutionize the world of music retail? And how did it launch or birth the idea of the combo store? How did the move to suburbia engender what some of us may remember as these mall stores? How did combo stores become big boxes like Sam Ash or Guitar Center? And how did the advent of synthesizers really force retailers to either expand their knowledge base and diversify their merchandise, or in many cases, not survive? So those are a few of the types of stories you would explore from 1900 all the way to today. You could also meet some of the icons of our industry, the names behind the brands. You've heard of Sam Ash Music. Well, there's Bernice and Jerry Ash talking about how their company got started in New York way back in the early 1900s. And then to add some pizzazz and sizzle to your experience, there are musical moments that you can explore a variety of music clips. In this case, these clips represent music between the 1960s and 80s. So the idea is, once you've looked at the instruments, learned a little bit about them, then you watch these music clips and perhaps they have a little bit more meaning for you.
Help! 1, 2, 3, 4. I need somebody help, not just anybody help. You know I need someone I may not always love you.
Feeling better with you. Feeling better 'cause I'm over you.
Looking around, I look at a girl all over the top. You know, this score, make no put around.
So we hope that your experience at the Museum of Making Music not only introduces you to new music and new sounds and opportunities to make music yourself, but also enriches your knowledge and deepens your understanding of our industry. And speaking tonight to business owners and people like yourself, I'm really excited to share this aspect of our museum with you. And I look forward to welcoming you in person as soon as possible. So thank you very much for having me tonight.
Thank you, Carolyn. We appreciate the sneak peek of the Museum of Making Music, and we can't wait to go there in person. So thank you so much. So now we'd like to turn it over to Steve Wolff, Managing Partner of WWM Financial. Steve has over 35 years of experience in helping clients with their investments and has a wealth of knowledge with the markets. So please welcome Steve Wolff.
Thank you, Catherine. I was just rocking out to Booker T and the MGs. Haven't heard that in a while. All right, so I'm going to be putting on my glasses here because otherwise, somebody told me that I look more professorial, but otherwise I can't really see. So let's talk a little about, over the last year, I know I've been asked a lot about how the market has been able to go up so much when such a large part of the economy has been hurt by the pandemic. Well, with unemployment as high as 8 or 9% even right now, many people really are baffled by what's going on in the stock market. Now, all the way up, that the market's gone up, we've heard that the market was overvalued. Now, how could stocks be at such a high valuation today? Well, ever since last March, we've had what I would call a bifurcated market. Growth stocks good, value stocks bad. Now, the stay-at-home stocks did very well over the last 12 months as we played a lot more video games online. We streamed a lot more programs on Netflix, Amazon, and eventually Disney. The large technology stocks like Apple, Amazon, Google, Microsoft, etc., did extremely well. If you were in the digital stocks like Zoom, Teladoc, DocuSign, you did pretty well. If you were in the cybersecurity stocks like CrowdStrike or Palo Alto Networks, you did very well. Also, if you were in the semiconductor stocks like NVIDIA or Qualcomm or AMD, you also did pretty well last year. And the small stocks really came on probably starting in about July of last year and have done extremely well. And finally, if you've been in the granddaddy of all of them, Tesla, I'm sure you're pretty happy right now. On the other hand, if you were in the aviation stocks like Boeing or the airlines, you didn't do very well. If you were in the entertainment, leisure, or travel stocks like the casinos, the movie theaters, the cruise lines, the hotels, you did pretty poorly. Investing in oil companies was more than just a slippery slope. The oil stocks just did not do very well last year. In general, if you were in value stocks versus the growth stocks, you lagged the market. Now, so you know, the major stock indices are dominated by just a few large growth stocks. The S&P 500 and the NASDAQ 100 indices showed a huge gain in the last year because just a few stocks did really well. The top 10 stocks in the S&P index make up close to about 28 to 30% of the index itself. And the top 10 stocks in the NASDAQ index make up around 50% of the value of that index. So you can see when the Apples and the Amazons and the Googles and Microsofts all go up a lot, then the index goes up by a lot. And you can see that a handful of stocks represents really what happens to the markets. But up until very recently, if you looked at the underlying stocks in the indices, and especially the value stocks, many of the stocks were way down or were just managing to tread water. So let me get back to the question of why were the markets, why have they held up so well? First, we are in the midst of a digital revolution. The pandemic has forced many businesses to change the way they operate. And look at what we're doing right now with this webcast. A year ago, we wouldn't have even thought about doing something like this. But tell me something, how many Zoom meetings have you been in the last 12 months? I know people have told me they're Zoomed out. How much more shopping have you done online? How much more binge watching have you done on Netflix or Amazon or Disney? And how often do you use cash versus an electronic payment? And now think about artificial intelligence, commonly known as AI. The vaccines that are now available probably would not have been possible so quickly without it. The field of genomics or the genetics it's only possible right now because of AI. Robots have become smarter and smarter and faster and faster. This is what it must have been like to be living through the industrial revolution back in the 1800s. And now we're living through the digital revolution. And make no mistake, it is a revolution. Secondly, last year, the government spent an enormous amount of money to keep industries like the airlines alive. It spent money on giving people paychecks. And unfortunately, while many small businesses still went under, it allowed a lot of people to continue to pay their bills. Third, the Federal Reserve basically said it was going to keep interest rates at practically zero for quite a long time. So this means you could get a mortgage for 3% or less than that. Some I've heard even getting it in the twos. business could borrow money or refinance debt at unheard of low rates, and they can invest in their own company. Keeping rates this low is important when valuing stocks. And for a long time, there's essentially been nowhere to go but stocks to get any kind of return on your money because interest rates are so low. Most people are not excited about buying a bond for 10 years and maybe making 1 or 2% a year. So they've had almost forced to go into the stock market. Some people put their money in a savings account or a money market, probably because they're of the uncertainty around the virus and they were afraid, and that's understandable. But literally, they've been making practically 0% on their money. And although this was okay for a short term, on a longer term basis, it's a great way to go broke. Now, fourth, a large amount of unemployed workers are coming from just a very few select industries. So it's not really widespread throughout the entire company, but it's the industries like the restaurants and the airlines and the hotels and the casinos. The reality, however, is that there are many other industries right now that cannot find enough qualified people to hire. And there are new industries and jobs popping up because of this digital revolution. Now, outside of the unemployment statistics, the economic numbers that have been coming in have really been not too bad. Now, having said that, stocks can't go up forever without taking a breather. There is a limit to how many widgets a company can sell, and certainly how many customers any company can have. And after such a large run-up in stocks over the past year, it would be normal to see a pullback, as there's a lot of froth in the market right now. But it's hard to know exactly when that pullback will come, because the government is trying to get a $1.7 trillion stimulus program through Congress right now. And so the government keeps priming the pump. And by that, I mean they're printing tons of money that's going to go into the markets, that's going to the economy. And all that money has to find a home. It's just sloshing around out there. So while printing money can help the economy for a while, eventually there's going to be a price to pay for that. And it usually comes in the form of inflation. Now, we haven't seen inflation to any large degree in quite a while, but the bond market is telling us that it might be on the horizon. While the short-term treasury rates are still at close to 0%, the 10-year bond is starting to tick up. And for the first time in quite a while, it's at about 1.3%. And that's a large uptick from where it had been last July, when the yield was only about 0.6%. The 30-year treasury bond is now about 2.1% versus about 1.25% last March, when this pandemic really got into full swing. Now, sometimes you take a look at commodities to see if inflation is happening. Oil prices have been spiking recently and are now more than $60 a barrel, which compared to about $36 a barrel last October is a huge spike. But interestingly, gold, which has always been acknowledged as a hedge against inflation, has been falling since last August. You know, it goes up and down, but basically it's been on a downward trend. Now, there's a new cowboy in town, I guess, and that's Bitcoin, and the mysterious cryptocurrency that has skyrocketed in price, but so many people have a hard time understanding what the heck it is. I'm really not sure how inflation will affect the cryptocurrencies. It is interesting to note, however, that the more money that the government has borrowed, the more Bitcoin seems to go up. Could be a coincidence. I'm not sure if there's a cause and effect, but it certainly bears watching. As I said earlier, so far the economic numbers look okay, but we want to be cognizant of inflation and rising bond yields. While I asked Catherine to come back into our presentation, the bottom line is that we think stocks, especially growth stocks, are a little overvalued, and we would not at all be surprised to see a pullback. So I kind of expect that, but again, you never know when that's going to happen. But even if there is a pullback, we believe we're still in the early innings of the digital revolution. So unless there's some black swan event, we still think stocks, especially those that favor the digital economy, are a good place to be as far as asset allocation. We still, and as far as asset allocation, we still favor stocks over bonds for longer term investments. But that does not mean you shouldn't have value stocks in your portfolio, because we still believe in diversification. We still believe they will grow, and at some point, there's usually a reversion to the mean. So, you know, we don't want to get rid of other stocks completely, but certainly the stocks that are in the digital revolution should do very, very well over the next several years. So want to thank you for listening to me. And now if there are any questions, we'd be happy to answer them. And Catherine, you might
So it
explain
looks
how to
like
do
we
that.
do have a question that came in. You kind of just talked about a little bit, perhaps, but let me just ask it of you. So, with the potential for inflation presented by U.S. financing of stimulus initiatives, is it time to hedge? Is it a good time to be looking at holding gold or other precious metals?
Well, it's kind of what I just said. I'm not sure at the moment that gold is necessarily the place to be. We do have a little bit of that in our model portfolios. I know that gold and silver are a hot topic and cryptocurrencies are a hot topic, but I think I would be a little more patient and wait to see if inflation really is coming on strong. Because if not, I don't think you really want to be too heavily in the metals.
Great. All righty. Well, if there's more questions, we'll make sure we address some more at the end. Actually, there's one more question that came through. So, which digital or AI stocks specifically are good investments?
Which digital stocks?
Which digital or AI stocks specifically are good investments?
There are so many. With 5G coming on board right now, some of the safer stocks are things like Marvell Technology, Skyworks Solutions, those types of things. There are some very small stocks that I'm putting into my caveman portfolio and high risk on those stocks, but there are companies that are dealing with both healthcare and with technology itself. And rather than giving you those right here, because each person is different, and I don't know who really is asking the question, to be honest with you, so I don't know how to answer it. I don't want to get myself in trouble by saying to someone who's 85 years old that they should be investing in some stock that's not appropriate for them. So if you have a question afterwards, I'd be glad to talk about it individually.
Great. All righty. Thank you very much, Steve. We appreciate your insight.
All right, thank you.
Thank you. All right. So now we have our featured guest speaker, Rachel Ivanovich, an enrolled agent from Easy Life Management. Rachel has an M.B.A. from SDSU with an emphasis in finance and taxation. She has over 20 years of experience working with individuals, business owners, preparing individual, corporate, and trust returns. And we've collaborated with Rachel on various tax planning topics and clients over the years. And we're pleased to announce that we're in the beginning stages of strategically working together and adding value to our existing clients and new clients. And now, without further ado, please welcome Rachel Ivanovich.
Thank you, Catherine. Thank you. And welcome everyone to tonight. So Catherine's actually promised you a unique and fun evening, and yet they've asked me to share tax strategies for 2021. So without further ado, I'll do my best to give you a unique and fun evening as I present 2021 tax strategies. So who here likes to pay taxes? I don't think anyone. Many of my clients, they have told me over the years, going to see you is just about as fun as going to see the dentist. So I put together a high-level overview of about 6 to 10 strategies that you can think about, but honestly, I could probably talk for about an hour on each of these subjects. So please take copious notes, and do know that these are going to be summaries. I'm going to be talking about quite a few topics tonight, and I'm happy to answer questions at the very end of the presentation. So the topic tonight is about tax planning and tax strategies. So why tax planning? So honestly, why not tax planning? Do you brush your teeth? You want to make sure that if you go to the dentist, you're not going to have any cavities. Same thing when you go to see your tax advisor. You really don't want to pay any more taxes than you legally have to. So tax planning really involves putting together a financial plan, or working together with your tax advisor, with your financial planner, from a tax perspective, to pay the least amount of tax that's legally possible, and to actually take advantage of all the benefits of the tax code that you can. So my clients always ask me about, how can I save money on my taxes? And really it starts with, and if you really logically think about it, if you make money, you're paying tax. But are you? Not all income is created equally. So keep in mind, there is capital gain income, there's ordinary income, there's passive income, tax exempt income, and tax deferred income, and a few other categories that I haven't mentioned. So let's talk about retirement planning, given that retirement planning is something that we all kind of can wrap our heads around. But it's not just saving for the future. So by maximizing your retirement contributions annually, this does allow you to contribute dollars to your savings pre-tax, or maybe even post-tax if you're looking at Roth IRAs or other instruments. But this actually allows you to overall lower your taxable income and your modified adjusted gross income, or your MAGI. The thing that you need to keep in mind is not just what tax bracket you're in, and the fact that the tax system is progressive, meaning, because a lot of clients will call me and they'll ask, so Rachel, what tax bracket am I in? Because I want to make sure that my income doesn't fall into that higher bracket. So you have to keep in mind that it's kind of like going upstairs. You'll pay a certain percentage at the lower rates, and then as your income grows, you'll pay a higher and higher percentage on that next dollar. You do need to keep in mind not just your taxable income as it pertains to your tax bracket, but how it pertains to thresholds and phase outs. And what that means is, as your income goes higher, you're going to be losing some of the tax deductions and benefits of the tax code. So if you work together with your financial advisor and your tax advisor, you'll be able to take advantage of things such as the child tax credit, the net investment income tax, keep that low as possible. You can avoid the additional Medicare tax. You can itemize your deductions, that's what that Schedule A means, and keep all of your deductions as you plan ahead. And if you may or may not know, capital gains income is taxed at 3 different rates depending on what your income is. So you want to keep your eye on your income level so that you can maximize all of these deductions and credits. By putting money into retirement accounts, you can take advantage of tax deferred and tax-free compounding. So make sure that you're doing this from a very early time when you start working. Also, I tell clients all the time, if you're an employee, make sure that you're taking advantage of any company matching that's available to you or other programs. So let's just talk about what you can put away for 2020 and 2021. So clearly 2020 is already over. However, you still have time to contribute to both traditional and Roth IRAs up until the tax deadline of April 15th. And the bad news is the limits have not increased for 2021. So you'll see there on the screen that you can contribute up to $6,000 to a traditional or a Roth IRA, or a combination of each of those. And if you're over 50, you can put another $1,000 away. And as I said, you definitely want to start early putting this money away so that you have time to let it grow, either tax deferred or tax free. 401ks, 403bs, and most 457 plans, you'll see there the limits are $19,500 plus a $6,500 catch up if you're over age 50. So be sure that you're maximizing your retirement plans to keep your income as low as possible. The good news this year is that income levels have increased, meaning if you want to put money into a traditional or a Roth IRA, you have to keep your eyes on what your income is. So if you're participating in a 401k through your work, you cannot necessarily deduct that traditional IRA contribution that you make, but you still can make that contribution and then convert it to what's called, through a planning tool called a backdoor Roth. So you may or may not know, but in order to contribute to a Roth IRA, your income has to be below certain thresholds. So this is a special little loophole that you definitely want to work with your tax advisor and your financial planner to make sure that you're not being caught off guard by things called the pro rata rule. So as I said, I could talk about this for hours. There's so many different things that you have to plan for and make sure that you don't get caught up in any traps and unwanted tax consequences if you're going to be doing a backdoor Roth. The next thing that I wanted to talk about in terms of lowering your taxable income are Roth conversions. So you may or may not know what a Roth conversion is. So I'm just going to give you a very high level overview of what that is. So if you have money from a former job, from a 401k, and it's been rolled into an IRA account, That money is sitting there, and when you take a distribution from it, later you're going to be paying tax on that. You do have the advantage of tax-free growth with that. However, it may make sense for you to work together with your advisors to do a conversion. So what that means is you can convert a certain amount or all of your traditional IRA or your 401k into a Roth account, meaning that you're not going to be paying tax later. It's going to grow tax-free, and when you take a distribution out of this Roth account when you retire, then you won't pay any tax at all, thus lowering your income overall and making you eligible to take advantage of all of those different deductions and credits that I was talking about when I began my presentation. Things that you really need to keep in mind and take seriously are the following. You're going to owe tax on this conversion. So you do need to work together with your advisors to make sure that you have money available to pay for said conversion. And it's really important to plan ahead for this. This is a long-term strategy. I tell clients, start thinking about it in a year such as this, where we have a lot of people are unemployed, there's a pandemic going on, people have been laid off, potentially your income's not as higher as it was. It's a good year potentially to consider converting some of your former 401k account, which is now sitting in a rollover IRA account, or something that's sitting in a traditional IRA account. It might be time to be considering doing this conversion. One thing that you really need to take seriously is previously, before the Tax Cuts and Jobs Act was enacted at the end of 2017, if you went in to see your tax advisor in the spring to do your taxes and all of a sudden you didn't have enough money to pay your tax bill, you could recharacterize this conversion and put it back into the traditional IRA account. You can't do that anymore, so you want to be absolutely certain that you're ready to do the conversion and pay the taxes on it when it comes time to file taxes. The thing that's really nice about a Roth conversion is there's no age or income restriction on this. You just need to make sure that you're planning ahead, because there are some negative consequences that can take you by surprise if you aren't looking into the future and making a solid plan. Keep in mind, once you have done this conversion, and if you're over 59 and a half and you've owned your Roth account for at least 5 years, you can take distributions out of this account, and it is tax-free, as I've mentioned. So some of the negative consequences to a Roth conversion. Again, be sure you're planning ahead. One reason to be doing and considering Roth conversions when you're younger or not full retirement age is because if you're already going to be, if you already are paying premiums for your Medicare and you're retired and receiving Social Security, there's going to be a look back period of 2 years, and your Medicare premiums are going to cost you more every month. So you want to make sure that you're planning ahead for this so that you're not taken by surprise and paying more for your Medicare Part B and D. Same thing with Social Security benefits. You may or may not know your Social Security is taxable up to 85%. So you may, if you do that conversion, you may be boosted into a higher bracket and be paying more on your Social Security. So you want to be sure that you're planning ahead for that. Same thing, you don't want to be doing a Roth conversion when you're talking about capital gains, because there are 3 rates for capital gain income, a 0%, a 15%, and a 20%. So you want to make sure if you're going to be doing a conversion that you do not have a lot of capital gain income that might be boosted up into that 20% bracket. The same thing with the net investment income tax. And I'm going to talk about that next. This is a sneaky little additional Medicare surcharge that they added about 8 or 9 years ago. So this kicks in when your income, if you're single, is $200,000, and if you're married, $250,000. So keep in mind, if you're doing that conversion, look at your other income sources and make sure that you're going to be staying under the thresholds so that you won't be caught by surprise with that net investment income tax. So let's talk a little bit about required minimum distributions, because the laws have changed quite a bit over the past few years. Again, like I said, I could talk about each of these topics for an hour. This is just a really high-level overview. Please put your questions in the chat. I have webinars for each of these topics and would love to give you more information if we had more time. But tonight was supposed to be a unique and fun evening, so I'll try to keep each of these brief. So required minimum distributions. What this has to do with is 401k plans and IRA accounts. When you reach a certain age, which they've recently changed, it was previously the year that you turned 70 and a half, and now it's the year April 1st when you turn 72, you have to take a certain amount of money out of your traditional IRA or your 401k account. Otherwise, you're going to be hit with a 50% penalty on the amount that you should have withdrawn, which is a pretty steep penalty if you consider if your required minimum distribution was $20,000, you're going to be paying $10,000 as a penalty for each year until you actually take that required minimum distribution, or RMD. You may know for 2020, RMDs were waived, meaning you did not have to take them, but we are back on track for 2021. So be sure you're planning ahead. If you are turning 72 and a half this year, you have until April 1st to take this distribution. Make sure you're planning, talking to your tax advisor, talking to your investment advisor to make sure that you are taking the correct amount out of your accounts. The other thing that's really important is make sure you're tracking basis. And what that means is the amount they've already paid tax on. So for instance, if you put money into a traditional IRA and you weren't able to take that tax deduction because your income was too high, make sure you're not paying tax twice on that money. The other thing to keep in mind is, and another thing that makes Roth accounts so attractive, is there is no RMD for Roth IRA owners. However, if you're a beneficiary of a Roth IRA, you do have to make sure that you are taking that RMD. So back to that sneaky little tax that I mentioned earlier, the net investment income tax. Really want to talk just high level on some strategies to minimize this, because this is something that people sometimes don't plan for. And it's really important because this is an additional 3.8% tax that you pay on your net investment income. So the question is, what is net investment income, and what does it include and what does it not include? So net investment income includes interest, capital gains, dividends, income from passive investment activities, rental and royalty income. But what it doesn't include are wages, Social Security benefits, alimony, tax-exempt interest, and income from operating a non-passive business. There are several other categories of income that I haven't mentioned, but those are kind of our high-level income groups that you have to keep in mind. So, does this apply to you? As I said before, if you're single and your income's over $200,000, yes, this will apply on your net investment income. Again, 3.8%. You can save this if you plan ahead. How? If you're married, it's basically a marriage penalty because it's not double, it's not $400,000, the level is $250,000. So definitely you're going to want to plan ahead for this. So 2 ways to minimize the net investment income tax is reduce your modified adjusted gross income, reduce your investment income, and be sure that you're looking at the big picture and talking to your planners. So ways to minimize your investment income for NIIT planning purposes. So clearly we all want to grow our wealth. So one way to continue to grow our wealth but not pay this extra tax is, if you're going to have a lot of capital gain income, work with your advisors to harvest losses by the end of the year so that you're offsetting your capital gains with losses, because then you won't count as investment income for NIIT purposes. Also, you can invest in municipal bonds because you don't pay tax on the interest from municipal bonds. And if you have municipal bonds from your resident state, you're not going to be paying resident California tax either. Another strategy for minimizing your investment income is to invest in non-dividend paying growth stocks. So you're going to have that growth aspect. You'll be growing your net worth and your wealth. However, you won't have income showing up on your tax return annually. Next thing you could potentially do, but it does involve planning ahead, is shifting income to lower income family members. Be careful, I'll talk about the kiddie tax in just a minute. The other thing that you could do is to buy corporate bonds at a discount or near par value. Other strategies to minimize this net investment income tax is to reduce your modified adjusted gross income. You can do this, as I said, by planning ahead so that you're reducing your income long-term, so that when you actually have investment income, that you're going to be taking distributions from your Roth IRA. So plan those Roth conversions early on when you're when you're working, when you don't have a lot of investment income, so that by the time that you take your distributions, that's going to be all tax-free. The other thing that you can think about is charitable contributions. You can actually take your appreciated stock and you can donate it to your favorite charity. It won't be included in your income, and you still can gift that to your favorite charity, and they can have the benefit of that appreciation. So something to plan ahead for, definitely a great strategy for charitable contributions. Like I mentioned before, municipal bonds, we've got that tax exempt interest that doesn't count for the net investment income tax. Also plan ahead. If you own a business, you're going to be selling your business, you may consider doing an installment sale. If you have rental real estate or commercial real estate, make sure you're taking advantage of 1031 exchanges or like-kind exchanges, so that you're either deferring that income or you're spreading it out over time. Something else that you could do to plan to reduce your modified adjusted gross income is to invest in tax-deferred annuities. So, like I was saying, my big tip is be proactive about your tax planning. Think about it like brushing your teeth. You definitely want to be doing this, talking to your advisors. Just a few more topics before we wrap it up for questions. Charitable contributions, great way to reduce your taxable income and to help your favorite charity. Some rules have changed over the past couple of years. A lot of clients will ask me, they say, so Rachel, so how much money can I do the maximum? I want to give the maximum away for charity. Just give me that. And then I say to them, well, are you giving away 50% of your income? Because that's what the limit is. Over the last couple of years, you can actually give away 60% to a qualified organization. And then this last year, 2020, you can give away up to 100% of your adjusted gross income under the CARES Act. Another thing that the CARES Act enacted was if you do not itemize, and a lot of people are not itemizing anymore because the standard deduction was changed under the Tax Cuts and Jobs Act about 2 years ago, there's a $300 above the line deduction for non-itemizers. So keep that in mind. Another thing to keep in mind is that 100% deduction under the CARES Act only applies to public charities. So if you're thinking about giving money to a private foundation, there's no go. One of the things that I work with clients on quite a bit, especially now that the standard deduction is so much higher, is taking advantage of qualified charitable distributions. And what that is if you are over 70 and a half, or now 72, and you still want to give away to charities, you can actually take your entire RMD, or required minimum distribution, and you can elect to give it directly to a charity, and then that income won't be included in your adjusted gross income. Great way to still give money away to a charity and to keep that money out of the bottom line for your taxable income. Another strategy would be, like I said before, to gift appreciated stock. So as I was saying, that the CARES Act has bumped up the limits of how much you can give. However, if you're gifting appreciated stock, the old limits do apply. So keep that in mind if you're considering that as a planning opportunity. So moving on to the next topic, everyone wants to know about taxes and kids. So what if I shift my income and I invest in different accounts for my kids? What does this look like? So Congress got wise to this, and they enacted something called the kiddie tax rules, which technically what that is on the unearned income or investment income for your children who are your dependents or under age 24 if they're students, if they have investment income, so interest, dividend, capital gains, they will have to pay tax over anything over $2,200 at the parent rate. So this has gone back and forth under the CARES Act. It was one thing. Under the Tax Cuts and Jobs Act, it was another thing. So keep in mind now it's reverted back to the old rules, and now if you are filing a return for your children who are your dependents who are under age 24, they will be taxed at your rate. So keep that in mind before you start shifting income. Do work with your planners to make sure that you know all of the ins and outs of this. Another thing that you can take advantage of is to plan with 529 accounts. So this is a way to save money tax-free for your kids or your grandkids or anyone's kids for that matter and have it grow tax-free if they're going to be using this money for higher education. And actually, recently, they expanded 529 accounts for federal purposes, not California, for federal purposes to also pay for tuition for K through 12. So these are great accounts. You don't get a tax deduction up front. However, you can put the money in there. It grows tax-free if you use it for educational purposes. One of the great credits, if your income is under $400,000, is the child tax credit. This applies to your children who are under age 16. It's a $2,000 credit per child, reduces your tax dollar for dollar. Another credit that's great is the child and dependent care credit. It's up to $600 per child or dependent if you need to be paying for a caregiver for them when you're working. What I do tell clients, though, is to be sure that if you are an employee, that you're taking advantage of any of the employer-sponsored plans that are out there. So for instance, if you do have children, you're paying arm and a leg for them to go to childcare, be sure that you're taking advantage of any dependent care benefits that your employer offers, because you can put up to $5,000 annually into an account. You don't pay tax on it as long as your kids are going to childcare. Another thing that your employer may offer is a flexible spending account or a health savings account. These are great opportunities to save money. Do keep in mind with flexible spending accounts or savings accounts, if you don't use the money that you have elected to be used for medical expenses, you do lose it at the end of the year. Health savings account, on the other hand, you can roll over from year to year, but you do have to make sure that you have a high deductible health insurance plan. So be sure you're working with your advisors on that to make sure that you have all your ducks in a row. Self-employed individuals, this is a great planning opportunity. You also can set up HSAs or health savings accounts. The limits are around $7,000 for families, $3,550 for individuals. And you can contribute to this HSA still for 2020. You have until April 15th still to make that contribution. So maybe it's time to think outside the box. Maybe it's time to do some planning. Just two more slides for you. If you have a business, maybe it's time to start a business. You can write off some losses for a couple of years. Great opportunity under the Tax Cuts and Jobs Act was Section 199A. They introduced the qualified business income deduction. If you do have income from a business, this is a 20% deduction off of your net profit from your business. Great benefit for business owners. It also applies to rental real estate in some circumstances, real estate investment trusts as well. So great planning opportunity there with the Section 199A or QBI. I could talk for hours on the qualified opportunity zones. Be sure that you're talking to your advisors on this if you have capital gains and you want to reinvest these into areas needing investment, into qualified opportunity funds. I believe they just bumped the deadline to make this reinvestment until March 31st of 2021. This involves the deferral of capital gains tax until December 31st of 2026. If you hold your investment 5 years, I believe there's a reduction of capital gains, 10%, 7 years, 15%. And if you hold your investment for 10 years in these opportunity zones, you don't pay tax on the fund profit. So great planning opportunity right there. So again, work together with your advisors to maximize your tax savings. And then we're going to kind of end on the nothing certain but death and taxes, the gift and estate tax planning. So many clients have been asking me, since we do have a new administration, will we be seeing changes in the estate and gift tax? Yes, most likely. I do not have a crystal ball, but I'm guessing yes. So currently, each individual has a lifetime credit of $11.7 million. This is set to sunset end of 2025 back to $5 million. Just keep in mind, continue to plan and use current law. You can give away $15,000 to any individual still. Currently, the maximum gift and estate tax rate is 40%. This is imposed on anything over that 11.7 million on all assets valued at death, but your beneficiaries do still receive that step up in basis, which is great. So consider potentially gifts for medical educational purposes. Those are kind of the freebies. And again, work with your advisors. Make sure that you're brushing your teeth or doing your tax planning. It's really important to save money, because who wants to pay more than they have to? So thank you so much. And stay tuned. Things keep changing. And I hope you have a wonderful evening. Thank you so much for your time tonight.
Thank you, Rachel. That was very informative. We do have a question that somebody was asking if you're seeing new clients for this tax season.
Absolutely, yes.
Wonderful. I know there's always new rules and things are changing. This is definitely something you want to stay on top of. Once again, one of the reasons why we collaborate together is there's a lot of similarities and things that we kind of do, but at the end of the day we have different disciplines, and at the end of the day we want our clients to make more money and save on taxes. So
absolutely, let's keep more money in everyone's pockets.
Exactly.
So, and Rachel, did I understand you to say that you can contribute a 529 plan to someone who is not necessarily your child or grandchild?
That's my understanding.
Okay, so all of our clients out there, I've got some grandchildren that might need some help. 529, oh, I can't say that. Never mind.
Oh, Steve, love your son's sense of humor.
Okay, well, are there any other questions at this time?
It's riveting material. Come on, I'm sure you all have questions.
Okay.
Okay.
Next time I'll bring you back.
Yeah, thank you, Rachel. We really appreciate you taking the time to be with us tonight. And once again, we had a full evening. We heard about the stock market. We heard about the Museum of Making Music. We had tax planning strategies. Hopefully you learned something new tonight. We do appreciate all of our clients, and thank you so much for working with us and spending your evening with us, and hopefully you enjoyed yourself this evening. So on behalf of everybody from WWM Financial, thank you and have a good night.
Good night.